Xiamin, investment analyst from PC Financial. So in our latest quarterly investment guide, we continue to prefer Chinese equities for two main reasons. One would be attractive interest rate differentials, and two, we do expect Chinese corporates to have relatively more resilient corporate earnings compared to companies based elsewhere. So we think that the recently released economic data continue to support our view, and we do see some positive spillover effects on the Hong Kong stock market as well. So China recently reported better than expected GDP growth in the fourth quarter last year, and this brings full year GDP growth to 2.3%, and China will likely be the only major economy to report a positive growth for the whole of 2020. So, although there are certain areas that remain of concern, such as weaker than expected retail spending, we think that the current situation does not seem to warrant a much more accommodative monetary policy, and this would mean that interest rate differentials would remain attractive for the time being. And secondly, as mentioned earlier, that we believe that corporates with a significant presence in China were likely to be more resilient in terms of corporate earnings compared to companies based elsewhere. But in our report, we also point out that Chinese corporates listed on the Shanghai Composite Index, their valuations are no longer cheap. So Chinese investors are definitely looking at places where Chinese corporates will also list and valuations are still quite reasonable. And that is in Hong Kong. So, according to the data provided by the Hong Kong Stock Exchange, we do see Chinese investors net buying Hong Kong equities since December last year. And also with the ongoing US-China tensions, we believe that Chinese corporates will feel that to look at Hong Kong as a secondary place of listing besides or rather than the US. And this in turn would encourage more southbound fund flows into the Hong Kong stock market. With that, I end my presentation for today.